Capital One is looking to buy Discover for $35.3 billion, but why could this be a good thing for the entire economy and for investors as a whole? Let's go ahead and break it down. Now, over the last day or so, I've put together some notes and put out 5 things that you should know if you are considering investing, and one major thing that give us all a little bit of hope. So you definitely want to stay tuned for that one. So I'm gonna run down the list. I'm not gonna go in any specific order. Honestly, I'm just kind of skipping around the page, make sure we check off everything. The first one is this. Right now, Capital One and Discover are the 4th and 5th largest credit card companies out there. And if they were to combine, they would control 22% of the entire US credit card market. That's a lot. That's a lot, okay? So that is pretty incredible, but for context, who are the biggest credit card issuers? Like, we know the biggest credit card companies, right? It's Visa, it's MasterCard, it was Discover, it was Capital One, and also you have American Express. But the issuers, right? Like, who do you go to say yes or no when it comes to a credit card? Because you don't go to Visa.com to get your credit card, right? You go to JP Morgan, you go to Citibank. Well, here's the thing. If they were to combine, they would be larger in terms of the number of credit cards and customers that they have than both JP Morgan and Citigroup combined. And JP Morgan is the largest bank in the United States. They would have more customers on the credit card side than JP Morgan and Citigroup combined. That is great if you are someone on the Capital One side. But here is the reason why they're actually doing this. And this moves us into number 2. This pulls us into what we call vertical integration, meaning from the top to the bottom, you own all the things that need to happen for your product to exist. A company like Apple is very good at this, right? Everything that you have to deal with Apple is usually within Apple's network, right? You get an Apple phone, they create all the pieces, you don't really get to customize and do a whole ton of things outside of that. Tesla is also known for this. They own the production factories and everything in between. Well, when it comes to the credit card factor, think of it like a JP Morgan. Remember, they issue like the loan side of it, but they don't own the credit card processing network. Well, Discover does. So this means that you have Capital One who makes the loans. They have that. Now you have a credit card processing company. You have an additional bank because Discover is also a bank, and you put all that stuff in-house. This is going to make them a lot closer to American Express, which brings us down to number 3. American Express is an incredible credit card company because of their vertical integration. They can set the terms for everything. What do I mean by that? They set the interest rates. They know exactly how much money you are making and spending because they are the bank and you may have your account there. But also, when you decide to swipe your card, the merchant side, right? If I run a business, I have to pay for every time that you swipe your card, right? Well, they control that too. So they're getting paid on every single side of this equation where previously they didn't. And they get to control what bonuses you get as a credit card consumer and everything in between, when again, previously, they didn't really have any control over that. Capital One had to go through Visa and had to go through MasterCard. If this is approved, they can set all this stuff on their own. And again, they would have 22% of the market and have a lot of power in what we are all paying for our credit card rates. Is this great for the consumer? As a consumer who, that uses my credit card, gets my reward points, and absolutely pays my bill off every single month. I don't carry balances over here. I'm not paying these people. So that part, I don't think would be a good thing if they were approved. But speaking of approval, which brings us into, what are we on? Number 3 now? There's a 50% chance that this could occur. And honestly, in a presidential election year, when you got a lot of politicians saying a whole lot of stuff, I don't see a lot of them being okay with this move. And we have some evidence because remember, JetBlue and Spirit. These were 2 smaller airlines trying to combine and merge and compete with the bigger airlines, American Express, Southwest, Delta, so on and so forth. You could argue that this is very similar to that. You got 2 smaller banks, 2 smaller credit card companies you might not think of that much compared to the larger ones, trying to combine and compete with that upper tier, upper crust, if you will. Well, because we all don't like credit card debt and we know how expensive and dangerous it can be if it gets out of control, I don't really see a lot of people signing off on it. So when you start to do a lot of the research and kind of talk to people in this regulatory space, it's about a 50-50 shot that this is going to happen. If it were to close and it were to go through, it will be sometime later this year, 2024, or at some point in 2025. As someone looking at the stock market, I wouldn't be super optimistic or excited about investing in Capital One or Discover. I did think Discover financially, they were a good solid value company for the long term, but not anything that's going to run up some numbers, right? And do it. I don't see it being the best stock in your portfolio, especially if you're watching this channel. We found way better companies than Discover at this point, but I think it's an okay stock. What I don't want to do is lock myself into a position or put money on the line when I don't have a better than 50% chance of knowing what's going to happen. And I don't want it to be in the hands of a political cycle or someone who's upset that signs or does not sign off on this deal. So personally, I don't believe it's worth the risk. I think there are a lot better stocks that can make you more money now than investing in either of these at this point in time. That could absolutely change over time, right? We'll see what happens in 2 years, 3 years, 6 months. Who knows? This could absolutely change down the line, but right now, I'm not excited about investing in either of them. But as we move on, here is the thing that is the most important for us all. I said this many times on this channel before. There's only one reason why people buy things when it comes to the stock market, when it comes to business. There's only one reason why you would buy a business. There's only one reason why you would buy a stock. It's because you believe that that company, that stock is going to grow. Nobody says, hey, I'm going to buy this business, I think it's going to fail and lose money. Nobody does that. If you are a bank, if you are Capital One, why would you decide to buy another bank and another credit card processing company to integrate into your own? Because you think the American public is going to continue to buy and spend money. That tells us, remember, we know that 2/3 of our entire economy is based on what? Consumer spending. They are putting, what was it, $35.3 billion on the line that says we are putting our money where our mouth is. We think the U.S. economy is going to continue to grow in the near future, and we want to be in a better position to profit from it. Now, is this the only thing I'm going to look at and say, hey, no recession, the economy is going to grow forever and ever, and the stock market is going to be up forever and forever? No, but this is a very good sign because remember, they are tracking what people are putting on their credit cards. They are also a bank. They see how healthy the consumer is in some aspects, and they see what is going on. They also see how inflation plays into this as well. But it's only one reason why you would buy is because you think the economy is going to continue to expand and people are going to continue to spend. There is no way where they did this and did not pay attention to the unemployment rate. Because remember, if people are unemployed and they don't have a job, they don't pay their credit card bills. And what does that do? Right? That hurts a company like Capital One and like Discover. They wouldn't jump into that with thinking that things were absolutely going to fall apart. Right? Those two things would not mix. Now, saying all that don't mean they can't be wrong. Okay, people can be wrong and deals not go through or deals don't go the way as you expect. However, they did put their money on the line, and that is what their money is saying about what they think is going to happen. And in the last, what has it been, 12 months or so, the market has showed that we have been in a good position. So too has inflation started to fall off. So too has the GDP numbers, gross domestic product, and everything in between, even though it doesn't feel emotionally the same way as it did in 2018, 2019, or any point before. So still a mixed bag, but I do think that this is a great signal for us all. But if you still want to look at credit cards as a place to invest, and there is a very good case for doing so, I actually did a video breaking down what were the best credit card companies to invest in. If you want to learn more about that, you want to check out this video right here.